Price action entails the art of reading historical and recent chart data and using these data to predict the movements of prices, predict the future movement of prices. As you can see, what we do is predict, right? That is it. The only thing is that what is our difference? The difference between a professional trader and a trader that is still taking losses is that a professional trader predicts with what? With, in this case now, as a price action trader, right? You are predicting with historical information. Oh, when I saw this, market did this. I'm predicting with historical information, while newbie traders just predict with what they see. Oh, it looks like market is going up, let me join. It looks like market is going down. Oh, I'm seeing green candles, let me buy, stuff like that. Understand? However, professional traders are able to predict the market because of what they use historical data. Oh, when as far back as in 2000, when market did this was the result. It did this again, continuously, throughout March. It did this throughout April, so you can be able to accurately use it. Obviously, like I said, right, even when you are back testing, it's important to note, right, that using the exact same system, you are still going to see stop losses. Even when I backtest, I see that, oh, I'm still always going to see stop losses. However, with good risk management, we are going to be 100% fine. Okay, so now that we've talked about, every single thing entailed in price action, we are now going to go further and now talk about the elements of this price action trading. What is entailed in this price action trading? What are the things that we look out for when we go onto the charts? You understand? And what are or maybe before we go, let's just talk about the characteristics of price action trading so that we know that, okay, these are the things that we don't look out for, these are the things we look out for, stuff like that. So let's just go ahead and just write that what are the characteristics of price action trading. Okay, so what is this price action trading about? Like we mentioned it, right? But what are the things that it is about? What are the what are its do's or don'ts? Okay, one, we don't use indicators. Very important. We don't use indicators. So if you're a price action trader and you are using indicators, you are wrong, because with price action trading, we don't depend on third-party information. Remember that indicators are third-party information, and by the way, indicators are mostly lagging. When you use indicators, they are mostly lagging. They will tell you to buy when market has already moved and tell you to sell when market has already sold. So they are mostly lagging. So we don't use indicators because of what? They are third-party information. Instead, what do? We read directly. What does the market tell me to do? What does structures tell me to do? Stuff like that. So two, we also don't use the news. So that means if you trade price action and and you want to use the news to predict the market, you'll be wrong. We don't use the news. Okay, you can use the news for your own personal knowledge, to know what is going on to know what is going on in the US, to know what is going on in England. It's perfect. However, we don't use the news to predict the future of prices. Okay, so what else again do we do when it comes to price action trading? It's important to note, number three, right, that it is chart structure based. It is chart structure based. Okay, that is, chart structure is the skeletal framework of price action trading. Okay, if you understand chart structure in its entirety, and you know that when we talk about chart structure, we also talk about fractals, structure circles, stuff like that. Bullish structure, bearish structure. If you understand chart structures correctly, then you can be able to accurately predict the market. Because if you see that, oh, this chart structure is on clear structures of higher highs and higher lows, it means that what? Okay, probably you can be able to join that bullish trend. And if you see that this structure is on clear structures of lower highs and lower lows, then probably you can be able to join that bearish trend. Okay, so that is the difference between other strategies with price action trading strategies. Okay, some other type of strategies you don't even use. For example, you are trading fundamentals, you don't use chart structures. You just look at the news and you just strike in. If you are trading indicators, you don't use chart structure, because if the indicator tells you that, oh, it is overbought, you just sell. It is oversold, you just buy, without the knowledge of chart structure. Okay, so Yeah, that is for this. So let's just keep it with these three characteristics of price action trading. Then now let's go to the next. What are the elements of price action trading? When we talk about the elements of price action trading, we're talking about every single thing. What are like the tools? What are the tools? What are the things we see when we come to price action trading? And I gave a sneak peek on this one. I'll talk about the characteristics, right? And I said that what it is chart structure based. It is chart structure based. Okay, so when we're talking about price action trading is chart structure based. This means that what? For you to be able to perfectly predict the future movement of prices, you need to be able to understand chart structure. And you need to be able to read the chart structures from historical data to recent data. So that is what, you can go to the monthly time frame, see the historical data, understand the structures, and correlate it with what is going on weekly, daily, 4 hours, 1 hour time frame. You can correlate it and be able to basically just predict the future movement of prices and make money with it, right? So it's chart structure based, right? So, but very important, right? What are the types of this particular chart structure? Or before we even go to the types, let's just, we're going to come back to that. So it is chart structure based. Understand? So number two, what are the other elements, that we use again? Let's just add trend lines. Even though I don't use trend lines as often, but it does not, mean that trend line is also not a good tool. Trend lines, okay? So what are trend lines? Trend lines, as we know, are diagonal support and resistance tools. Okay, so obviously, as we know, these are trend lines. Okay, so trend lines, I'm still gonna talk about, show you guys every single things. But this line right here is the trend line. What are the uses of trend lines, right? Trend lines checkmate the strength of a trend. For example, in this case, if price keeps respecting a trend line, it means that the trend is strong. While in this case, if price keeps respecting a trend line, same thing also on the bullish and on the bearish, it means that price is strong. So far, it keeps respecting a trend line. If it violates the trend line, it shows weakness in the trend. If it violates the trend line, it shows weakness in the trend. So a trend line is just basically, a confirmation tool. It allows us to know if a trend is strong or if a trend is weak. What are the other things? Number three, we're going to be talking about what is the other thing? The Fibonacci. The Fibonacci. Fibonacci is one crazy hell of a tool. You understand? As a price action trader, you must understand how to use Fibonacci, because the Fibonacci, right, is a tool that is going to allow us to know where a retracement is ending. Okay, if a retracement is ending, what does this mean? This means that price is ready to move in the current direction of trend. Okay, so if Fibonacci allows us to know that, oh, this level here is where a retracement is going to end, so that you can now be able to pick a position and swim with the wave of the ocean. Okay, obviously retracements are movements against the wave of the ocean, right? So the Fibonacci allows us to know that this is where this movement is going to end, and now you can be able to place a position and ride through, the new movements. Okay, so that's the Fibonacci. Okay, so what is the next tool that we are going to be talking about? The next tool that we are going to be talking about is going to be number 4. Okay, so the next tool that we're going to be talking about, we've talked about chart structure, trend lines, we've talked about Fibonacci, then now we'll talk about horizontal support and resistance. Okay, horizontal support and resistance. Now, what is this horizontal support and resistance? It's important to note, right, that horizontal support and resistance are horizontal lines, on the charts that allows us to know sensitive support areas and sensitive resistance areas. Now, what are the advantage of knowing sensitive support areas and sensitive resistance areas? The advantage is, if you know that this level is sensitive on the chart, and for example, you are on a buy position, right, and you know that price is getting to a sensitive resistance level, okay, and this sensitive level was shown to us by the horizontal resistance zone. And has shown us that this resistance level is a sensitive level. I can be able to walk away in profit, or I can be able to break even. Okay, so basically, it allows us to know, sensitive resistance levels. Same thing with sensitive support levels. For example, if I'm on a sell trade and prices get to an horizontal support level, and when it gets there, I know that anything can happen, right? It can choose to either keep piercing below the horizontal support level or respect it. But in order not to take the chances, right, when price gets to an horizontal support level, I can decide to walk away with my entire profit, or I can decide to break even. You understand? So basically, these are the essence of all of these things. Okay. So now, what is the next, element that we are going to be talking about? Let's put it right here as number 5. Potential reversal area. Potential reversal area. Now, what are potential reversal area? Potential reversal areas are levels on the chart that prices get to and may not be able to go beyond. Sometimes it could be the Fibonacci 61.8 level. It could be the Fibonacci 78.6 level, where these two Fibonacci levels I just mentioned, whereby these two Fibonacci levels can end a retracement. It could be the horizontal support or resistance level. It could be the trend lines. It could even be some chart structure levels, right? So the PRA is just basically a compound word, right? For levels that prices gets to and may not be able to go beyond. You understand? Very, very important. Okay. So now, what is the last element of what? Of price action trading, which is number 6. Right here, number 6. We are going to put it as what? As the current structure circle. Current structure circle. Now, what is current structure circle, right? Current structure circle is the most, it is the most real-time levels that prices is currently trading. You understand? For example, we're bringing price from the monthly time frame, right? And we're on the 1 hour time frame, and we're looking for a trade entry opportunity, right? What are the most recent structure, okay, and the most recent zone that prices is going to trade within? Okay, that is the current structure circle. And usually when we trade, we don't trade beyond the current structure circle, either beyond to the upside or below to the downside. We don't do that. Okay, we trade within the current structure circle. Okay, very, very important. But like we said, these current structure circles are the current levels on the chart that prices is going to trade within. Okay, so these are the current levels that prices is going to trade within. Okay, so that is what these current structure circles are about. So all of these are very beautiful tools that we are able to now throw into the market and basically make money with in real time. Okay, so now having all of these things right, we are going to be taking them bit by bit and talking about them. But instead of just talking about them on the plain chart, we are going to talk about them. Sorry, instead of just talking about them on the whiteboard, we are going to be talking about them on the real chart also. But either or, right? Let's just start from what the first element of chart structure. We said it is what chart of price action. We said it is chart structure based. Okay, so we are going to start by treating this. What are these chart structures in its entirety? Okay, let's put the chart structure right in the middle. Then let's put this under it. Okay, so now what are chart structures? Okay, it's important to note, right, that chart structures are coordinated movements of prices on the charts. Okay, so they are coordinated movement of price on the chart. I always say this, right, that when a novice come onto the chart, right, oh, the novice sees blue green candles, you see red candles, and he thinks that these candles are random movements. However, right, understanding the market, studying the market, and being abreast to the market, you know that all of these movements are actually making like patterns. they are making like patterns. Some are moving in clear structures of higher highs and higher lows. Some are moving in clear structures of lower highs and lower lows, and some are ranging. Obviously, there's no money to be made in a ranging market because it means market is flat. Okay, so basically, when it comes to the trending market, right, we know that market, is trending to the top side by what? By making clear structures of higher highs and higher lows, or it's trending to the downside by making clear structures of lower highs and lower lows. So chart structures are, like I said, is the skeletal framework of what we do as price action traders. Okay, so now what are the types of chart structures? Types of chart structures. Okay, so let's throw this to the middle. And let's put this under, right? Okay, so type of chart structures. Number one, as we all know, we have the bullish chart structure, and number two, we have the bearish chart structure. Okay, it's important to note, right, that the bullish chart structure entails a coordination of higher highs and higher lows. This means that when it comes to the bullish chart structure, we see clear coordinations of of higher highs and higher lows. While for the bearish chart structure, we see clear coordination of of lower highs and lower lows. Lower highs and lower lows. Okay, so these are the coordination of both. Okay, so when it comes to the bullish structure, right, this is what we mean by higher highs and higher lows. Market keeps trending upwards like this. Okay, remember that after every push there must be an exhaustion. After every push there must be an exhaustion. After every push there must be an exhaustion, which leads to another push, right? So these are clear structures of higher highs and higher lows. This means that this low right here, let's make it a bit smaller. Okay, for example, this one right here, this is an higher low level. Why? Because it's higher than this. This is also an higher low level because it's higher than this. This is also an higher low level because it's higher than this. This is also an higher low level because it's higher than this. Then this right here can just be regarded as a low. Okay, so what about for the bullish side? This is an high. Okay, right here, this is an higher high. How about here? This is another higher high. And here, this is another higher high. And this is another higher high. So these are clear bullish structures. What about for the bearish structure? What is entailed in bearish structures? Okay, so clear structures, as we can see also, of lower highs and lower lows. Okay, so let's go ahead and write the notes on them. Okay, for example, right here is LL, which means lower low. What about here? LL again, lower low because it's lower than the previous. LL means lower low again because it's lower than the previous. Then this is just L. Okay, what about here? Here at this point, it means that LH, lower high, because it's lower than the previous high, while this is also a lower high. This right here is also a lower high. This right here is also a lower high. Okay, so these are clear bullish structures. These are clear bearish structures. Okay, so like I said, we'll also go to the charts, and we'll see it for ourselves in real time use. We'll see all of these things by ourselves, right? Okay, but however, this is what it is when it comes to bullish and bearish structure. Okay, the other part of chart structure I'm going to be talking about are structure circles. Okay, because after studying these bullish and this bearish movements of prices, right, we now discovered again that this bullish and this bearish movements, there are different structure circles within this movement. That is what they all don't move the same. For a bullish structure, right, it doesn't move the same. You understand? And for the bearish structure, they don't move the same. They are in different structure circles, which now made us to study structure circles, also known as fractals, and allowed us to be able to, understand it and be able to see how to be able to make money with the clear understanding, mark my words, clear understanding of chart structure and chart structure circles. Okay, so now let's go on to the next page right here to talk about that. Okay, so here, this is structure circles, structure circles. Okay, so now I'm going to take this to below right here. Okay, so what is going on when we talk about structure circles, right? It's important to note that when we talk about structure circles, we're talking about the different movements of either the bullish chart structure or the different movements of either the bearish chart structure. And there are rules that encompass either the bullish chart structure or the bearish chart structure. There are rules, for trading them, right? So for the rules, right, we will just go ahead. Like we said, charts, structure circles are basically, unique movements, each unique movement. You understand? But before then, we'll talk about the rules. Okay. So rule one of structure circles, it means that what a small or a break of a small structure, a break of a small structure cannot affect the big structure. So if there's a break of small structures, it has no business affecting the big structures. Okay, let's go ahead and throw out rule one very quickly. For example, prices start making big structures like this. These are likewise structure circles. Okay, we'll still get to the part where we said structure circles are measured by the length of the exhaustion. Okay, and I'm also going to be sharing the other way that structure circles can also be identified and separated. So now we can see this movement, right? Then we now saw price starting, smaller movements. Then this smaller movement was now where the break of structure happened, where the last higher low was taken off, which now sends prices down. Now, I have no business within this zone. I have no business within this zone. The maximum I can sell to is the beginning of this new movement. This is the maximum I can sell to, the beginning of this new movement. Okay. In fact, sometimes if it is a retracement, 61.8 is the earliest level. If it is a retracement, 61 point, like I said, is what is the earliest level. But basically, these are this is the first rule of structure circle. Okay, so the same way we talked about it on the bullish structure, let's also go to the bearish structure to also show this exact same rule also when it comes to structure circle. Okay, then we now see prices making small movements like this. Okay, and there was a break of structure. The last lower high got taken off, right? Now, the maximum you can buy to is here. We have no business here. We have no business here. We have no business here. Why? Because the number one rule of structure circle says that what a break of a small structure cannot affect the big structure. So you can see that what all of these ones are small structures. Why? Because of what? The length of their exhaustion, the length of their exhaustion, the length of their exhaustion. Okay, so what are we going to do, right? Let's talk about the second rule of what? Of structure circles. Rule number two of structure circle. It states, right, that a break of a big structure can affect smaller structures behind it, or behind, or before it. Okay, so the second rule says that what a break of a small structure can affect smaller structures behind or before it. That's what a break of a big structure. Now, what does this mean, right? For example, if we see price start on smaller structures this way, then price now generates a big structure, and this big structure now push prices to break structure right here. You understand? We know that the structures that have been affected is the structure that starts from here. Why? Because a break of a big structure affects all of the smaller structures behind it. So far they are of, the same unique movement. I'm also going to mention that. You understand that so far they are of the same unique movement. I think that should be my third point. They must be of unique movements. And I'm going to explain why they must be of unique movements. But either all right, the number one rule says that what a break of a small structure cannot affect the big structure. And number two says that what a break of a big structure can affect smaller structures behind or before it. It can. And in some situations where these structures are not the same, then it cannot. You understand? So that is just the idea. So take this off and talk about the number three, of this. So number three, it says that what for a break of a big structure to affect the smaller structures behind it, they both must be of, you know, they they must be likewise structures. You understand? So if there's a break of a big structure, right, and there's a small structure behind it that is not likewise, it basically, it basically has its own unique movement, right? So it would mean that what there's a high probability that the break of the big structure may not affect, the break of the big structure may not affect the small structure in that instance. Why? Because what the movement was different. Okay, the movement was different. So for a break of a big structure to affect the smaller structures behind it, they both must be of the same, they both must be of the same movement, you know, movement and what and they both must be of the same movement. And apart from the same movement also, they must at least, we can be able to put them together. So they both have the same movement. Let's just leave it this way. You understand? Now, what do I mean? For example, these are two different examples here, where one, we saw prices make movement like this, small movement, right? When prices went, made a big structure here and broke. Okay, so now in this case now, if I'm placing a sell trade at the break of structure, right, I could decide to take my profit at this level if the opportunity is in the direction of trend, or I could decide to take my profit at this level if the opportunity is 61.8. So what does this mean? This means that what a break of this higher low here has affected all of the structures from here. Okay, so it has affected the structures from here to here. All of the structures have been affected. However, let's look at another example. Let's take this off. This is an example of the case that what, okay, all the structures are likewise, right? Now, let's look for an example that the structures are not likewise. For example, we see prices start slanted like this, okay? And all of a sudden, we see prices start moving straight like this. Okay, spreads start moving straight like this, and eventually there's a break of structure like this, right? If I'm placing a sell, there's a high probability that there's a high probability that the take profit may not affect this level. The take profit may not affect this level. It will have to be here. Even though you can see that the structure that got broken is bigger than this and this, but because their movements are different, they are not likewise. They don't resemble each other. They are not likewise, So because of that, right? It's important that we must follow these three rules when we're talking about structure circles. Okay, so now one of the other important things about structure circles, right, is that structure circles can be read by the length of their exhaustion. So they can be read by the length of their exhaustion. So now let's take all of this off and let's talk about the length of their exhaustion. Let me Yes. So number four, Campbell, structure circles can be read by the length of the exhaustion. Remember that what after every push, right, there must be an exhaustion. It's normal. After every push, there must be a rest phase. This is the movement of the market, and that's why it's called a wave movement, because after every push, there must be a rest phase, right? So structure cycles can be read by the length of the exhaustion. Okay, so what do I mean? For example, this is push, this is exhaustion, right? The smaller one, push, exhaustion, the smaller one, right? Then price start making big structures. Okay, big structures like this. If there's a break of structure right here, we know that what that structure cycles can be read by the length of the exhaustion. So it is not the push we are reading now, it is just the exhaustion. We are only reading the exhaustion when it comes to the measurements of structures. Okay, so it's the exhaustion that we are reading. Okay, so very important. Structure cycles can be read by the length of the exhaustion. This is very, very important. Okay, another example is this. Price start making big structures, right? Then let's start making small structures. Okay, so if there's a break of structure now, we know that what is the max we can sell to. What are the exhaustion? This is exhaustion 1, exhaustion 2, exhaustion 3. You can see that these are small structures in comparison to this exhaustion, which is big, and in comparison to this, which is big. Understand? So basically, it's important to note these 4 rules when it comes to understanding and mastering chart structures. Okay, so the next thing I'm going to be talking about, right, is trend lines. Okay, which is the other tool that we mentioned about price action. Okay, so trend lines. Okay, so what goes on with trend lines? Okay, so it's important to note, right, that trend lines are diagonal supports and resistance tools, and trend lines checkmate the strength of a trend. Okay, so trend lines are diagonal support / resistance tools, and this particular tool, it checkmates the strength of a trend. Okay, so like we said earlier, right, if a trend is strong, then the trend should keep bouncing off a trend line. If a trend is weak, then it means that the trend can pierce through the trend line. So it's important that we also apply our trend line just to be able to, just like an extra confirmation. Obviously, for those that follow my analysis, you see I don't use trend lines as much. But however, they could be useful for additional confirmations, right? So now, we said trend lines are diagonal supports and resistance tool, and it checkmates the strength of a trend. Okay, so what are the 2 types of trend lines? We have the ascending trend line, and here we have the descending trend line. Okay, so the ascending trend line checkmates the strength of a bullish trend. For example, this is a bullish trend, right? The ascending trend line, it checkmates, it makes sure that everything bounces off this. Okay, everything bounces off this. That's the essence of having, the ascending trend line. So if there's a breach of the ascending trend line, it means that there's a high probability, right, that the bulls are done and the sales have taken over. What about for the descending trend line? The descending trend line checkmates the strength of bearish movement. Okay, for example, this is this, 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 this is this. Okay, so now a descending trend line, right, it checkmates the strength of a descending trend. Okay, so like we can see in this case, right, if market keeps respecting the trend line, it means that the trend line is strong. Here the trend line was strong, here the trend line was strong, here the trend line was strong, but there was a point where prices broke above the trend line, indicating weakness in the trend. So that is just the essence of trend lines. It allows us to understand trends so that we can be able to write prices. We understand trends. So it allows us to be able to, buy at levels, sell at levels, and basically just have fun and make some money, right? So now, what is the next thing? The next thing is the Fibonacci. Let's go ahead and write that out. The Fibonacci. Okay, so what is this Fibonacci tool, right? It's important to note that the Fibonacci is a retracement and an extension tool. A Fibonacci allows us to know where a retracement might be ending, and the Fibonacci also allows us to know where an extension might be ending. So Fibonacci is a very important tool for us. Like I said, if we know where retracement are ending, it means that what we can be able to place a buy in the clear direction of trend. Okay, and the same thing also, if we know where retracement might be ending, that means that what if we're on a position, we can be able to take profit where the retracement would end. So Fibonacci is useful for entry, Fibonacci is useful for exit. You understand? So Fibonacci is one of our major tools when it comes to price action trading. Understand? So what are the most important Fibonacci numbers, right? So Fibonacci retracement numbers and Fibonacci extension numbers. Okay, so for the Fibonacci retracement numbers, right, we all know that the most important is 61.8. Then sometimes it stretches to 78.6, right? So these are the most important, Fibonacci numbers, and these are the ones that I look up to. Obviously, for the Fibonacci retracement numbers, we have the 23.6, correct? 38.6 or 23.8, whatever, 38.6. Then the most important Fibonacci retracement number is what? It's the 61.8. 61.8, also known as the golden zone. Then we also have the 78.6. This is in situations where 61.8, which is the golden zone, cannot hold on to prices. Then prices stretches down to the 78.6, and at 78.6, we can be able to confirm, that okay, there's a probability that the retracement might have ended because these are retracement levels, and we can be able to pick, a position in the direction of trend. Okay, so now what are Fibonacci extension numbers? The most important Fibonacci extension numbers that you need to know are 100.0. Sometimes it's written as 1 on trading view. So the 100.0 Fibonacci level, this is like a number of completion. It allows us to know that, okay, whatever trade you are on, whatever it is, you can be able to take profit and complete at the 100.0 level. So it's like I said, it's like a number of completion, right? That, oh, if I'm in a buy, I can secure my buy without having to worry. So basically that is when it comes to the Fibonacci extension numbers, right? So now the other Fibonacci extension number is 161.8, which I don't use as much. And there's also 261.8, which I don't use as much. So when it comes to the Fibonacci extension numbers, the most important one that you have to know is the 100.0. Okay, so basically these are like the creme de la creme when it comes to the Fibonacci extension numbers and the Fibonacci retracement numbers. These are the two most important. Fibonacci extension, basically just this is okay. So basically, this is the essence of the Fibonacci. Be able to use it, know when a retracement is ending, because a Fibonacci, like we said, right, it allows us to know where a retracement is ending, so that we can be able to place a position in the very beautiful direction of trend and swim with the ocean, right? So that is it when it comes to Fibonacci. Okay, so the next thing I'm going to be talking about, right, is the horizontal support and resistance level. Horizontal support and resistance levels. Okay, levels or tools, right? Horizontal support and resistance levels, or horizontal support and resistance tools. Okay, so now what are these tools? What are these levels, right? it's important to note that the horizontal support and resistance tools, like we said, or resistance levels, are levels on the chart that are sensitive. Okay, using these tools, because they are a tool and they're also a level, right? Using the horizontal support and resistance tool allows us to know sensitive support levels and sensitive resistance levels on the chart, so that we can be able to buy at a support and sell at a resistance and basically make money. And for take profit also, we can be able to take profit at a resistance and take profit at the support also, and make money. You understand? So that our profits don't go into losses, right? So understanding, and making use of the horizontal support and resistance tool is very, very good. You understand? Like, we won't use this tool when it comes to chart structures. For example, right? If I see prices make movements like this, remember that these are clear bearish structures, right? What am I going to do? I'm going to use my horizontal, in this case, horizontal resistance tool to indicate, the last lower high, so that in case prices comes and breaks the last lower high, it means that, oh yes, price has broken structure, but it has broken this my horizontal resistance point, allowing me to know that okay, there's a high probability that from here prices might keep kicking to the top. Okay, and in this case now, same thing here also. If we see price making bullish movement, we would bring the horizontal support tool, identify this last higher low right here. Then when prices breaks below this last higher low, it indicates that the bulls are done and the bears have now taken over by violating this horizontal support level or violating this horizontal resistance level in collaboration this time around with chart structures. Okay, so it's important to note, right, that as much as we try to isolate all of these tools, they should be used intertwined. Okay, you should all use these tools that I just mentioned. They should all be used together. Okay, so what is the next one? The next one, like we said, is the current structure circle. Current structure circle. Current structure circle. Okay, so what is going on with this current structure circle? Like we said, I said that what current structure circle is, what is at this moment the current zone, the current zone where prices is going to trade within. Okay, the most important and the most current zone where price is going to trade within. Okay, for example, right now, if we see prices make movements like this, these are big structures. Okay, then price start making small structures like this, small structures like this. You understand? And and prices goes and makes this high. If I'm looking for a trade entry opportunity, what am I going to do? I'm going to identify this level here as my current CSC from the low side, and this level here as my current CSC from the high side. So at the low, I'll target as CSC. At the high, I'll target as CSC. This means for now, I don't want to go beyond, I don't want to go below or above this level. I just want to trade in between and make my money, because the structure that is this, if prices comes now, right, and break structure, the structure that will be affected is the structures that start from here. So I have no business below this level, I have no business above this level. I will just trade within structure circles. Okay, so what are the advantage of trading within structure circles? The major advantages are what are usually profits don't turn into losses, because sometimes, right, when you're trading beyond structure circles, in this case now, imagine you are selling now, right, and prices get here, you are encountering a support. Okay, remember we just talked about support, right? You're encountering a support at this level. It's a support within another structure circle again. So this move here, if you don't take your profits, can wipe all your profits out. So that's one importance of the chart structure, the trading within, CSC, right? We call it CSC, chart structure circles, so that we can be able to, take profits at due time, and we can be able to execute, a trade within the right framework of what we are supposed to be doing. Okay, so these are the tools that we've talked about. And like I said, as much as we kind of isolated them, they should all be used together to get the best result. Okay, don't just use trend lines alone. thinking you'll get results. Don't just use chart structures alone, but instead use the chart structures with the knowledge of Fibonacci, if you have one, with the horizontal support and resistance, the trend lines, and just collaborate them together. Okay, so now that we've talked about that, right? What is going to be next that we are going to be talking about? Okay, we are going to talk about multi-time frame analysis. Okay, because yes, we've learned about the tools, we've learned about this, we've learned about that, but multi-time frame analysis is also a very important conversation that we must have, because without that, how can we be able to drive in, how can we be able to drive in trade opportunities in the market without the use of multi-time frame analysis, right? So we are able to drive in the use of multi-time frame analysis because of okay. So but before we do that, right, let's just clear this out. Then let's just put it right here. Multi-time frame analysis. What is going on with the multi-time frame analysis, right? Okay, so what is going on right here within this framework? Okay, so whenever we go onto our charts, I've seen traders that like only trade, the 15 minutes, or only trade 1 hour time frame. And I always feel it's very myopic, right? Because, there's nothing as good as trading multiple time frames where you're able to see the market from a big time frame perspective and come onto a small time frame and pick a trade entry opportunity. That coordination and correlation of time frames are very important in your accuracy. You understand? So it's very important that we apply multi-time frame analysis, right? But beyond just applying multi-time frame, they should also be applied correctly. Okay, don't just jump from the 1 hour to the 15 minutes to the 4 hours. They must be correct. They must be applied accurately in an organized descending order. Okay, so they must be organized in a descending order. Starting from the monthly time frame, this should be the fourth time frame that you should open onto whenever you go onto the charts. Okay, so the multi-time frame analysis, right? We already said, first of all, that multi-time frame analysis requires a coordination of multiple time frames to seek trade opportunities. Okay, so you must collaborate, multiple time frames in order to seek, trade entry opportunities when you're talking about multi-time frame analysis, right? Okay, and we said it must be done properly. That's the most important thing. Using what, we call the top-down analysis. So it must be done properly using top-down analysis in what? In a descending order. It must be done in a descending order. What do we mean by a descending order? One, you must start from the monthly time frame. Okay, and what does the monthly time frame do? It gives you a wide scope. Okay, it gives you a wide scope of the market, allows you to know if prices overall is on a bullish structure or if prices overall is on a bearish structure. Okay, and remember that from the monthly time frame, just with the knowledge of that, it affects every other thing else, down to our entry time frames. Because if the monthly time frame, like we said, if the monthly time frame is bullish, this means if you go on to small time frames and you are buying, it means you are buying against the trend. So the monthly time frame basically defines, the entire scope of prices. Like I said, if the monthly time frame is buying, okay, the monthly time frame has showed you that, oh, clearly prices on clear structures of higher highs and higher lows. When you go onto your entry time frames, either the 1 hour, 15 minutes, or whatever entry time frame you use, right? If you are buying, that means, oh, I'm buying with the overall flow of the market, right? Because the monthly time frame is bullish. So if I'm buying on my entry time frame, it means I'm buying with the overall flow of the market. I'm buying with the direction of trend. While if I'm selling, it means that what I'm selling against the overall flow of the market, I'm selling against the tide, and what the trade I'm in is a retracement. Okay, so it's important that we know that. Okay, so what does the weekly time frame do? Weekly time frame basically buttresses, the information from the monthly time frame. So the weekly time frame basically buttresses it. How does it buttress? By widening it. Okay, on the monthly time frame, each candlestick, these are monthly candles, right? So the weekly time frame basically just expands them into 4 candles for a month. Okay, so instead of 1 candle for a month, the weekly time frame expands them into 4 candles for a month and allows us to, keep categorizing prices into their respective structure circles. Just keep categorizing it, and basically just understand prices better. Okay, obviously you know that from the monthly time frame to the weekly, I always categorize prices, into a range of focus. Okay, so this is the weekly time frame. Then what does the daily time frame do? Usually the daily time frame defines the current structure of prices. Usually it is done on the daily time frame. In fact, the daily and 4 hours usually, defines, or no, let's just use that the daily. The daily usually defines the current structure of prices. Okay, then what does the 4 hours do? The 4 hours /1 hour are what are our entry time frames. Okay, the 4 hours /1 hour our entry time frames. However, as everyone knows, I prefer to enter trades on the 1 hour time frame because the 1 hour time frame gives us a better risk to reward in comparison with the 4 hours. So basically, the 4 hours I'll just need to just expand the information from the daily. I'll just expand it a bit more, then take it to the 1 hour time frame to read the most active structures and pick a trade entry opportunity on the 1 hour time frame. Okay. So it's important that this has to be done properly. Like I said, it must be in a descending order, and these are all of the time frames that we use. And this is basically, everything when it comes to this. Okay, so the last part I'm going to be talking about today is going to be, our entry systems, our exit systems. Like I said, all of these are just, theoretical. Tomorrow we go into practical, you understand? But it's important to just understand every single thing we do, understand everything. That's the essence of the boot camp. So that no information is missing, no information is kept from you. Every single thing is exposed out and you guys just understand and go and rinse and repeat. Okay, so now what are our entry systems? Okay, entry systems. And after the entry systems, we are going to be talking about the exit systems, or we can do them together. Entry systems / what / exit systems. Okay, very, very important, topic, and we can put them together. Okay, so now when it comes to the entry systems, right, we have 2 types of entry systems. One is structural entry systems. Structural entry systems. And 2, we have the Fibonacci entry system. Sometimes I like to also, apart from the Fibonacci, I like to also call it the confluence, because sometimes apart from Fibonacci being at that level, you may also see support and resistance, at that level also. Okay, so 1, we said that we have the structural entry systems, and 2, we have the Fibonacci entry system, also known, I also call it a confluence entry system, right? So now within these 2 levels, what are the difference between these 2 levels? You understand? And you can be able to apply all flexibly to trade the forex market. However, right, when I'm trading the direction of trend, I prefer to use the Fibonacci entry system, which is the confluence, best used in the direction of trend, best used when trading the direction of trend. Okay, let me just write it in full. So direction of trend, that is when it is best used. Okay, what about the structural entry system? Okay, best used when trading a retracement. Best used when trading a retracement. Okay, so this is how you can be able to use either or. So now when I'm trading a retracement, right, obviously for the structural entry system, I can also use it when I'm trading direction of trend. I'm just talking about where it is best used, right? Obviously I can use it when trading direction of trend, but I prefer to use the confluence because confluence will give me entry, it will give me an earlier entry instead of waiting for break of structure and all. So that's why I prefer to use that. But either or, right? Let's talk about the first one right here, which is what? Which is the structural entry systems. Remember we've talked about structures, right? So now, how do I tap into an entry when it comes to structures? Okay. For example, if we see prices making clear bullish structures like this, right? When a break of structure happens, that is what the last higher low gets taken off. Some people also call it change of character, which is okay. You understand? You can either call it break of structure or change of character. Okay. So when a break of structure happens like this, what does it mean? This means that what? This means that price is no more bullish. Okay, price was originally moving on higher highs and higher lows. All of a sudden, prices took the last higher low off. This means price is no more bullish. Okay, and this means that what? A sell is ready. Okay, so when it comes to the structural entry system, you can be able to place your sell pinpoints, okay, and your stop loss above the last high. Okay, you can see entry, stop loss above the last high. You can be able to conveniently do this while what? Take profits, at what? At the lowest point right here of the broken structure circle. I just talked about structure circles, right? You can take profit at the lowest point of the broken structure circle if the opportunity is in the direction of trend. I've told you what it means when we are trading direction of trend or retracement, right? If you are trading a retracement, it means that what? It means that the overall context, the monthly time frame is bullish, and on your entry, you are selling. It means you are trading a retracement. Okay, direction of trend means that what? The monthly time frame is bullish, and you are buying on your entry time frame on the 1 hour and 15 minutes. Means that what? You are trading the current direction of trend. You understand? So basically, that is what it is. So now, when a break of structure happens, right, and you are selling, right, you can be able to hide your stop loss at the high right here and sell to either this level right here, which this level, if you bring out your Fibonacci, it will be known as 100.0, or you can be able to sell to a level around here if it's a retracement, and this level can be known as 61.8 when you bring out your Fibonacci, okay, in case the opportunity is a retracement. So now, when it comes to the structural entry system, this is known as entry variation 1, EV1. EV1, this means you are selling pinpoints at the break of structure. How about EV2? EV2 means that what? EV2 means that you allow prices to go back a little bit, which it does about 80 to 90% of the times. Whenever prices break structure, it goes back a little bit. In this case, we call it a what? We call it a discount. That is what it is. That is what? Instead of prices selling down, prices pushes back up in this case and goes for what is called a discount. So now when prices goes for the discount, you can be able to pick an entry right here. And this entry is called EV2, which is what? 61.8 pinpoint entry. 61.8 pinpoint entry. Okay, it's also known as what? EV2. Okay, so now at EV2, you can be able to sell pinpoints and sell to this 61.8 right here, or sell to 100.0. Okay, so that is what is known as what? As the entry variation 2. So entry variation 1 is very profitable. Entry variation 2 is also very profitable, and like I said, you can use them at will. Sometimes you enter entry variation 1 and prices goes back and give this discount at entry variation 2, and you're like, oh, I wish I waited for entry variation 2. And sometimes you wait for entry variation 2 and prices at entry variation 1 will just keep going downwards. You understand? So just use them at will. You understand? That is what it is. So now we've talked about entry variation 1 and entry variation 2. Now, what is entry variation 3? These structures that took prices up for the retracement, right? What does prices do with these structures? Prices goes ahead and prices breaks this structure. There's a break of this structure that took prices up for the retracement. Okay, so you can be able to place your sell here. Okay, so this is EV3. Okay, so let me just use break of structure after discounts. Okay, let's use that EV3. Okay, so this BOSAD, like we said, break of structure after discount, that is EV3. 3. Okay, let's push this pinpoint 61.8 a little bit right here. Then this is what the entry variation 3. So these are our 3 entry variations that you can use at will. Okay, and if you want, all stop losses can be kept at the last lower high right here. But for entry variation 3, since there's been another break of structure again, you can decide to keep your stop loss just above 61.8, above the last lower high. You understand? Which sometimes gives us, a better risk to reward. So all of them can be sold here or can be sold here. So basically, this is the concept of it. You understand? Right now, like this, I've talked about, the structural entry systems, and I've also talked about the exits. Okay, we know that when we are exiting, it's a retracement, 61 point direction of trend, 100.0. We are now fully aware about that. Okay, so now taking this back, right? Taking all of this back, we are now going to, just basically just, the same thing we did for the bullish. We just briefly just draw it out for the bearish. It's exactly the same thing, So on the bearish, same structural entry system, right? This is it, when the break of structure happens, like we said, some people call it a change of character. Okay, price was moving on clear bearish structures, and what happens? The last lower high got taken out. And it's important to note, right, that for the bullish structure, the only way to confirm a break of structure, right? Okay, on the bullish structure, that's when I say break of structure, that is what? Okay, price is changing from one structure to another structure, not continuing the same structure. Okay, the only way to confirm is that what? Okay, for the bullish structure, the last higher low gets taken off. And for the bearish structure, as you can see, the last lower high gets taken off. This is what confirms that, oh, price has moved from one structure to the other. Like I said, some people call it change of character, that, oh, price was on bearish character, now price is on bullish character. Okay, so either or works, right? So now, you can be able to place your buy pinpoint right here and place your sell at the last higher low right here. Okay, if you are buying, you can buy to this level if it's in the direction of trend, which is 100.0, or you can buy to this level if it's a retracement, which is 61.8. I'm still going to teach you guys how to use, the Fibonacci properly, 100.0. Okay, so these are the 2 levels that you can buy to. Okay, just depends if it's a retracement or it's a direction of trend, and I've explained, to you, how you can determine that. So here is what EV1, buying that directly, at the break of structure. EV2 means what? This counts to 61.8 right here. Prices comes back to 61.8. This is what? EV2. Okay, you buy pinpoint at 61.8, your stop loss is at the same level. Now, what is EV3? EV3, the structures that brought prices down, right? There's been a break of the structures that brought prices down. Okay, so we can put EV2, we can try to shift EV2 to pinpoint level right here. Then this level here will now be what? We are buying at what? We are buying at the break of structure after discount. Like I said, prices pulls back to 61 point for the discount. So after the discount, if we see a break of structure again, that means that what? This is EV3. Okay, and these are the structural entries that we are able to use in order to make profits in the Forex market. Okay, so now, what about the Fibonacci entry, which is confluence? Okay, so in this case now, right, when it comes to, the confluence, one of the most important things to do when it comes to the confluence, right, is to basically understand the direction of trend. You understand that? Understand the direction of trend. Okay, for example, if we see prices making clear bullish movements like this, okay, these are clear bullish movements like this, right? And what? And I'm looking for a trade entry opportunity. Okay, instead of waiting for, break of structure for me to be able to buy from here, naturally would have waited for a break of structure using structural entry, would have waited for prices to break. Okay, let me take this off. Using structural entry, okay, when prices comes for a retracement and ends at this level, let's say this level here is 61.8, which ends a retracement. Obviously, as we can see, right, prices is overall bullish, and this 61.8 right here is basically going to end a retracement. Remember, 61 or 78.6 ends a retracement. When it comes to structural entry, right, I must wait for a break of structure before placing a buy. Okay, and I'll buy back to this resistance point, the highest point of rejection. Okay, I must wait for a break of structure, then apply any of my entry systems to buy back when it comes to what? The structural entry. However, when it comes to the Fibonacci entry system, which I called the confluence entry system, okay, at 61.8, I can choose to buy pinpoint at 61.8 and buy back here. This means that what I'm going to buy here, okay, hide my stop loss at the last higher low. Anywhere I see the last higher low, I'm going to hide my stop loss there. So far, the last higher low is below 78.6. I'm going to hide my stop loss. Okay, so this low right here, I can choose this low, then hide my stop loss below, buy here, and buy to this level. So this one, it allows me to sweep prices from the ground instead of waiting for, instead of waiting for the break of structure. I'm able to sweep prices, where it is ending. Remember that our retracements end at either 61 point or 78.6. So if you don't want to buy pinpoint at 61.8, you can say, okay, let me gamble and see if prices, will stretch a little bit further again to 78.6 in order for me to get a better risk to reward. And at 78.6, you can be able to buy pinpoint at 78.6 and what? And at 78.6, what can you do at 78.6? You can be able to buy back, to this resistance. Now, when it comes to stop loss, our entry will be pinpoints here. This is the structural entry. Then when it comes to stop loss, I will hide my stop loss below this last higher low right here. My stop loss will be here. My stop loss will be here below the last higher low. Then, from here I will write. So far prices respects this window. My stop loss is not going to be. My stop loss, it means that price has traded into another structure circle. Okay, but so far prices respect this window, my stop loss is going to be safe at this point. So that is the advantage of the confluence entry. So same thing also on the bearish side. On the bearish side, if we see prices, if we see clear bearish structures, like I said, the confluence is what best used when trading direction of trend. So you have to know direction of trend. So now if prices comes back for a retracement, right? Instead of waiting for a break of structure, like we would have done when it comes to the structural entry, when prices come for a retracement, so far it is at 61.8, I'm going to sell pinpoints. Okay, so far it's at 61.8, then what? Hide my stop loss above this last high right here. Okay, look for the last high. So far the high is above 78.6 because we know that our price can stretch to 78.6. So far the high, in this case, is higher than 78.6. I can hide my stop loss above. Then from here, sell to the ground. And I can decide that what, okay, let me wait and see prices stretch to 78.6. If it does stretch to 78.6, I can decide to sell at 78.6 and sell back to, the lowest point of rejection at this level. So that is the concept of it. Here now, 61.8, 61.8, here 78.6, then here is what is my stop loss. You understand? So basically these are the confluence, entry systems. You understand? And we can see how we differentiate from the structural entry system. With the structural entry system, like we said, this exact same movement, how would we have entered? We would have obviously allowed prices to complete its retracement at either 51 point or 78.6, but we must wait for a structural break. So sometimes if it's in the direction of trend, instead of waiting for a structural break, I'll just sell pinpoints. It saves me time, it saves me the effort, and basically, it does not allow me to miss a trade. So far it is in the direction of trade. You understand? So basically these are just, what every single thing is about. So theoretically, I've explained every single thing that we do, when it comes to trading. Tomorrow's class, I'm now going to expatiate it even more on the real life chart, showing you every single thing, the use of these tools themselves. So it's not just going to be technical type of analysis. No, I'm going to be bringing this tool out one by one and showing you how to apply the Fibonacci correctly, how to apply the trend line correctly, how to apply all of these, how to apply all of these tools, correctly, so that you can be able to, make some profits and correctly predict the future movement.